Corporate Finance Practice Problem. In this presentation, we're going to work a practice problem in Excel related to short-term loan, short-term financing versus long-term loan, long-term financing. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. Note that we have 2 tabs down below. You may have 4 tabs if you're working along with a practice problem worksheet. For you, 2 tabs will be the answer key, and then you'll have these 2 practice tabs. If I go to the second tab, we will have a similar format of a problem with different numbers. Going to go back to the first tab here. Information is going to be on the left. We'll put that into the blue area on the right. The basic scenario is that we're going to need a loan. We're going to be picking out the loan. Oftentimes when we think of a loan, we have a couple different options. We can lock down the rate for the loan period. You could think of this as being similar to if you're going to mortgage a house or something like that, where you have the 30-year fixed loan and you lock down the rate over the entire time period. Or you could say there's this flexible rate, a short-term rate that you could pick up, but if there's problems in the future, the rate could fluctuate depending on the market fluctuation. So obviously over a 30-year period, there's a lot of fluctuation that can happen with the rate over that time period. Similar kind of thing for a business loan. We could say, hey, look, I need a loan. I can either try to fix the loan over the time period that I need the loan for, but the rate's usually going to be a little bit higher. And then they'll say, hey, you can take this short-term financing rate and it's a lot lower, but you could result in some fluctuations with the rate over the time period. So you're taking on risk when you do that. So we have another situation, uncertainty into the future. We have this risk versus reward type of situation with regards to the loan financing rates. So the financing needed, we're going to say over the next 2 years is going to be the $700,000. We need a $700,000 loan. We need it now. We need it for 2 years. We think we're going to need it for 2 years, and we're going to pay it back at that point. So the fixed loan, we could take out a fixed loan, but it has a 10% interest rate. And then they'll basically say, well, then you can have a short-term financing option. You can take out a short-term loan, and for the first year, the rate is only 6%. And then in the second year, we can basically approximate what the rate will be. We might have different terms in terms of how the loan will be set up with a fixed second loan. There's no real restriction on different types of loans that could be set up. You can have a complex loan if the bank agrees to it or whoever's lending money with more complex interest structures to it that could be fixed, or there could be a flexible kind of rate that will be basically dependent on the market. So in this case, we're going to assume that the first year is going to be 6%, and then the second year is going to be the 12%. So if that's the case, then the question would be, well, if that's the case, which one are we better off at? Are we better off taking the loan with the 10% over the 2 years, or are we better off taking the financing for a different loan, a lower amount in the first year and a higher amount for the second year? Now, again, as we think about this, there's also other options to consider, and that's going to be, are these 2 loans locked in, or are these 2 interest rates going to be varied depending on the market? So typically, you're paying for a locked-in rate over the time period, and it might be a higher rate versus a flexible rate, which has the potential to be lower, but could fluctuate within the time period. That's going to be another thing to just consider. Also, just note that we have the time value of money here, in that the first loan has a lower rate in the first year, which means we pay less money. And if you take into consider the time value of money, we're going to have more or less interest paid in the beginning, which could have an effect just due to the fact that the value of the money is worth more at the beginning point. But let's not overthink it here. We're going to calculate these 2 items. So we have the interest payments are going to be paid at the end of each year. So notice a lot of loans that you've probably typically dealt with. The most common kind of loan that's going to be paid back, you're going to pay it each month, and you'll pay back both interest and principal. Loans can be set up, however, in a bunch of different type of ways. We're going to assume here that the payments are going to be paid at the end of, meaning the interest payments are going to be paid at the end of each year, and then we're going to pay the loan back at the end of the 2-year term, because we borrowed the loan for the 2-year term. So we borrowed the $700,000. We're going to be paying back interest at the end of each year, just interest, not principal, as you typically do for like a mortgage or something like that, where you pay both principal and interest. We're not making monthly payments here. We're paying back the whole $700,000 at the end of the time period, and then the rent on the purchasing power, which is the interest at the end of each year. That's a little bit easier for us to calculate because obviously we can just calculate the interest for an entire year as opposed to a monthly type of calculation. Also note that if you have a loan that has interest and principal, then of course you have to consider when you're paying back the reduction of the principal. It's actually a little bit more complicated to make these type of calculations with the cost of the loan because you're paying back, both interest and principal as you pay back the loan. So there's kind of a trade-off for that. Usually people like that when you finance like a car because then they're really determining how much you can pay and they want the payment to be fixed. And so what you're sacrificing, however, is the fact that the proportion between the interest payment and the principal amount will have to change to make the payment basically fixed, right? The principal is going to go down each time you make a payment because some of the principal got paid off and the interest portion of the payment on the next one is going to be a little bit different. So we may talk about that a little bit in the future. Just note there's a lot of variance to the loans here. Now we want to just consider this concept of short-term and long-term financing options. All right, so we got the loan. Loan is going to be equal to the $700,000. Under the first option, we have a very straightforward option. We're just going to say the rate on the loan is going to be this 10%. 10% rate on the loan. Let's make that a percent. Go into the Home tab, Numbers group, percentifying it. And then we're going to go to the Home tab, Font group, and underline it. And then I'm going to say this is going to be the interest for year one, or for, let's say, 1 year. Because whenever we see interest, remember when you're talking about loans, it always means a year. And it's the same as if you're talking about like a salary. If someone asks you, what's your salary for wages or something, you have to assume something. You usually assume a year. How much do I make over a year? Same is true with interest. Well, typically, if nothing else is said, and they say the rate of interest is 10%, that means 10% per year. It makes sense to talk about interest per year even if you pay it monthly, because breaking down interest rates to a monthly amount results in very small interest rates that, it's easier to say for a year. Okay, so then we're going to multiply this out. This is going to be the 700,000 times the 10%. That's going to be the 70,000 then per year. And then how many years do we have this for? The years that it's going to be covered, 2 years. So we're going to pay 70,000 at the end of year one, 70,000 at the end of year two for a total interest that we're going to be paying the 70,000 times 2, or the 140,000. So that means we're going to pay 70,000 at the end of year one, 70,000 at the end of year two, and then we're also going to have to pay back at the end of the loan the 700,000 at the end of the 2-year period, paying back the principal as well. So that's going to be the total interest. All right, then we want to take a look at this option where we have this breakout between the 2 years and we have these different rates. So then we're going to say this is one way you can do it, and this is good practice just to build your tables. It's not a very complex calculation, but if you want to think about it systematically on how you would write this down so that you can write it down and think it through, show it to somebody else, right? If you could demonstrate it, then you know it. So we're going to say this is going to be year one interest. I'm going to put a colon, and that's going to be the loan amount. The loan amount, I'm going to put this in the inside here. So and then I'm going to pull the interest for year 1 and 2 in the outside. And then that's where we're going to then add the outside numbers up. So this loan amount is once again going to be the 700,000. Now the rate then for year 1, the year 1 rate is going to be equal to this 6%. Let's go ahead and percentify that, putting my cursor on that cell, Home tab, Numbers group, percenting it. There it is, percentified, Home tab, font, and underline. And then we're going to say this is going to be year 1 interest. So notice I put a little colon saying this is what we're going to do, and then I ended with that name. I'm going to indent these. I'm going to select these. This is just to make it look a little more fancy. You don't have to do this, but Home tab, alignment, increase the indenting. Then I'll indent this one, Home tab, alignment, increase the indenting. I'll pull this to the outside now. This is going to be equal to the 700,000 times the 6%. That's how much we're going to have to pay at the end of year 1 as opposed to the 70,000. Notice again, since we're paying less in year 1, we get to hold on to more money for a little bit longer. And due to the time value of money, that's a little bit better as well if you take into consideration that. So anyways, we're going to then go to year 2. Year 2 interest, colon, is going to be, I'm going to pick up the same thing. I'm just going to say this will be equal to the loan amount. This will be equal to the rate. And then this was going to be year 2 interest. And then the loan amount, same amount, because we're only paying off the interest. We didn't pay off the principal here when we paid the 42. And then the rate is now going to be 12%. No, it's kind of high. It's a little high. And then we'll go to the home tab, numbers group, percent. If the economy keeps going the way it's going now, the loan will actually pay us. That'll be funny. But in any case, we're going to go to home tab, font, and then underline. And this will be equal to then the 700,000 times the 12%. In other words, we might have negative interest rates at some point here, the way things. But in any case, highlighting these or selecting them, home tab, we're going to go to the alignment, increase the indenting. Select this item, home tab, alignment, increase the indenting, and then we'll pick up the interest, let's make it the total interest in the outer column now equals the sum of the outer column. So interest for year 1 was 42, interest for year 2, 84, for a total of 126,000. Home tab, font group, and underline here. Let's put an underline here. Home tab, font, and underline. So you can see that year 2 would pay less total interest. Notice again, that means we're going to pay 42,000 at the end of year 1, 84,000 at the end of year 2, and then we pay back the total principal that we borrowed, the 700,000. Whereas up here we pay back on both years the 70,000. So one, we get to pay it a little bit later, which is nice, because we get the time value of money, and we're going to be paying a little bit less in the total interest. But again, that's questionable as to whether these two would be locked down or not, or if we're estimating if these two interest rates could vary with the market, then we could also be taking on risk with regards to what happens in the market. Okay, so then let's go to the second one. Same kind of thing. Let's do this a little bit faster now. Practice building our tables with this. We're going to say we now need 750,000. The fixed rate is going to be 14%. And then the short-term financing options could be for a 3-year. Now we have a 3-year loan. So year 1 would be 12%, year 2, 16%, year 3, 12%. Again, most of the time, the question would be oftentimes is fixing the fixed rate will typically be higher if I could fix it over a 3-year time period versus having some kind of flexibility within the rate. If I allow the bank or whoever the lender is to have flexibility in the rate based on market conditions, then you'll typically be able to pick up a lower rate, but it'll possibly you have more risk depending because the market went bad and the rates jumped up all of a sudden. Then you're taking on that risk. Same kind of thing you've probably seen in a home loan or something like that, a short-term financing or lock it down, right? So let's consider this. If we knew this was the term for the 3 months, then we're going to compare the 14 flat compared to this adjusted rate. Once again, we're going to assume that we're going to be paying interest at the interest rates at the end of each year, interest only. And then we'll pay the entire 750,000 back at the end of the loan period, which will be the end of the 3rd year, at the end of year 3. So we'll start off, we're going to say the loan amount. Let's say we're going to do the flat option, make it nice and easy and say, hey, I just want to make a flat rate, whatever it is. And I don't want to mess with any kind of variable, schmariable thing here. We're just going to say this will be equal to the 14%. Let's go ahead and percentify that, go into the home tab, numbers group, percentifying it up top. Home tab, font group, and underline it. This is going to be the interest per year. So we'll say this will be equal to the 750,000 times that 14% interest. Remember, when we say interest, we typically mean a year unless said otherwise. So that's for each year. We're going to be paying 105,000 at the end of each of 3 years. The interest only. That's not touching any of the principal, which is the 750,000. We're just paying the rent for the purchasing power of the money. The interest. So the years that will then be covered are 3. Let's put an underline here, home tab, font group, and underline, and then the total interest, then is going to be equal to the 105 we're going to pay each year for 3 years. And there's going to be our total. Okay, let's compare that to our short-term financing option. We have 3 years now, so we're going to try to build our table nice and systematically so it can be nice and easy for us to read and for someone else to read for a 3-year time period. So this isn't complicated, but we have to basically calculate this with 3 different years. So we're going to say, all right, let's do the first one. Year 1 interest, colon, is going to consist of the loan, and then we're going to have the rate, and then we're going to have the year one interest without the colon. I'm going to put these on the inside, and then I'm going to pull the total interest payment on the outside, and then I'll have that do that for 3 years, and then I'll sum up the outside to get the total interest at the end of each year. So the loan amount is now $750,000. The interest rate starting out for year one, 12%. Let's percentify that cell. Home tab, numbers group, and percentifying it. And then we're going to then calculate it down here in the outer column. This is going to be equal to the 750,000 times the 12%. That gives us the 90,000. Let's put an underline here. Home tab, font group, and underline. Let's indent these cells now. Loan down to the year one interest. Home tab, alignment, increase the indenting. Let's indent this one again. Home tab, alignment, increase the indenting. All right, let's do it again for year two. So we're going to pay only 90,000 in the first year as opposed to the 105,000 that we would be paying under the prior option. So let's do this for year two. Year two interest, colon. I'm just going to pick these up with equals the loan, equals the rate, equals, and notice I'm hitting plus instead of equals, and I'm saying equals, but it's the same thing. You can use plus and pick that up just like you would with an equal sign, and then it'll put a equals plus in front of it, which looks a little funny. But it's easier to do that if you have a 10 key, because then my hand's over here on the 10 key, and the plus sign is more readily available than the equal sign. All right, so then we're going to say this will be equal to the 750 once again. The rate is now 16%. Whoo! We're going to percentify that, go into the home tab, numbers group, percentifying it. Let's put an underline while we're here, home tab, font group, underline. We'll calculate this out. This is going to be equal to the 750 times the 16%. Let's indent these then, selecting these three. Go into the home tab, alignment, increase the indenting. Year one interest, home tab, alignment, increase the indenting. And let's do it one more time for year three. Year three interest, colon. This is going to be equal or plus the loan, equal or plus the rate. And then I'm going to say, and this last one, I did the equal or plus, and I can't do it right there. Let me do that again. This should be year two interest, not year one interest. And this is going to be year three interest. All right. And then this is going to be equal to the loan amount, which is 750. The rate is now 12% for the third year. Let's go back on it, percentify it, home tab, numbers group, percentifying it, underline it, home tab, font group, underline it. Then we're going to say this is going to be equal to the 750,000 times the 12. There we have the year three. So then we have the total interest is going to be equal to the sum of trusty sum formula, adding up years 1, 2, and 3. And then we're going to underline here, go into the home tab, font group, and underline. All right, there we have it. So now, once again, we're paying less under this option. The second year, we had to pay a substantial amount more, but the total is less. Note that that's not always the case. Don't think that you should always do the short-term financing, but we're less on both of these options here. Again, also just note that oftentimes one of the things you're going to be taking into consideration will be the flexibility of the rate over the time period, not locking down the rate, and that's could be a significant decision, especially if you're talking about like the mortgage, obviously something that's a 30-year financing. Then the ability for the rate to fluctuate over 30 years is significant. Right? It could fluctuate a lot, but if in a couple of years it might be less significant. The risk could be less, but that variability of the rate is often something that you want to consider with regards to the decision.